Hello, hi everyone. I'm Shekhar from Momentum Lab. This is second episode in our factor investing series. So in the first episode, we started with value indices. We covered the basic methodology of how the value indices are constructed by NSE. And we've also seen a hidden flaw in the value indices and how they are constructed. So if someone who's interested to know more about the details of what this flaw is and how is it a value trap, please go through our first video. Now in the second video, I'm going to talk about more from the performance point of view. I'm going to show how these different value indices have performed, what has been their returns, their drawdowns, the volatility, rolling returns, etc. So the three major NSE value indices are NIFTY500 value 50, NIFTY200 value 30, NIFTY50 value 20. So I'm going to compare these three value indices against NIFTY500, a common benchmark, and see how they have performed. So I'm going to quickly summarize of our learnings from our previous video. So what we have noticed is that the value indices, they do not have a downside protection mechanism. As prices go down, let's say for any stock, then the relative rank of these stocks go up in terms of value. Now, when the weightage is skewed towards prices going down, then it's a lose-lose situation. You do not know when to exit because the falling prices will even further boost up the ranks of value score, and hence the value stocks will never exit from a value index. Whereas in terms of NIFTY50 value 20, there is this inherent downside protection mechanism where if a stock goes down in price, it automatically gets kicked out from the NIFTY50 because its market price or its market cap has come down. It moves down to Nifty Next 50 or something else like Nifty Mid Cap. And thereby automatically the stock is pushed out. So you are saved from the falling knife value trap, especially NIFTY50 value 20. So that's a theoretical understanding that we've seen in our previous video based on the methodological construct and how they have been constructed. Now we want to see in real terms, in terms of numbers, whether this is true or not. So what I'm going to do is I'm first going to share my screen and show you the high level returns that I've already calculated and kept ready for you to take a look. So as I mentioned, we'll be tracking these three indices. N500 V50, this is an acronym for NIFTY500 value 50, NIFTY50 value 20, NIFTY200 value 30, and NIFTY500. Now, these are the different matrices I'll be comparing upon and arriving at a conclusion. So if you take a look at the returns for these four indices, the time period is from Jan 1, 2009 till May 20, 2025. Why did I take from Jan 1, 2009? Because that's when the data point of NIFTY50 value 20 is being made available by NSE. Though for NIFTY500 value 50, NIFTY200 value 30, the data exists from Jan 1, 2005. Since the data for NIFTY50 value 20 is only from Jan 1, 2009, I wanted to have a common start date. So we compare apples to apples and don't compare different time periods. So if you see that during this entire time period, obviously the best returns are with NIFTY50 value 20, followed by NIFTY500 value 50. And then comes the NIFTY200 value 30. And lastly is NIFTY500. So as you're all aware so far that we just don't consider the CAGR alone. That's a good metric, but not a foolproof metric. It is actually meaningless to only rely on the point-to-point CAGR returns. In fact, we are more concerned about the rolling returns. The rolling returns also will take different time periods like 3-year, 5-year, and 7-year. Now, what does a rolling return mean? So let's say we have a time span of Jan 1, 2009 till 20th May 2025, right? So there are different 3-year periods within this entire time frame. So there is one time period of Jan 1, 2009 till Jan 1, 2012. Then there is Jan 2, 2009 till Jan 2, 2012. So you can see that there are so many 3-year periods within this entire time frame from 2009 till 2025 of the 16 years. Now we take all these 3-year returns and then do an average of all such 3-year returns. That is nothing but our 3-year rolling return. So this way we are going to avoid the bias of start point and end point risk, and we are more sure of what could be a possible return expectations if someone holds this strategy for 3 years. So we see that the NIFTY500 value 50 is at 15.15, and then NIFTY50 value 20 is at 16.06. NIFTY200 value 30 is at 13.84, and NIFTY500 is at 13.54. So again, we see that out of all these four, NIFTY50 value 20 outshines pretty comprehensively compared to the other three indices. If you take 5-year rolling return, then the NIFTY50 value 20 again outshines the other three. You see the 16.08% returns of NIFTY50 value 20 compared to 13.67 of NIFTY500 value 50, 11.87 of Nifty 200 value 30, and 13.78 of Nifty 500. If you notice, actually, the Nifty 500 value 50 and Nifty 200 value 30, these 5-year rolling returns are even less than Nifty 500. So in 3 year, it was good, but in 5-year rolling return, the Nifty 500 and Nifty 200 value have started to underperform even the benchmark Nifty 500. Only Nifty 50 value 20 is holding the ground. Let's take even longer period of 7 years. In 7 years, it even further worsens, especially for Nifty 500 value 50. It comes down to 12.3. For Nifty 200 value 30, it comes down to 10.47. Nifty 500 is at 13.2, whereas Nifty 50 value 20 is at 15.32. So in a longer time frame, the value strategies actually deteriorate. So this is nothing new. We have already covered this in our previous discussions on value indices. Also, it's the same phenomena that value is a cyclical index. The longer you hold, it is even going to get worse. Unlike other factors where usually we say that time in the market is better than timing the market, but it is vice versa in value. Timing the value strategy is even more important than the time spent in value strategy. So you can see the drop from 3 to 5 to 7 in Nifty 500 value 50. It starts at 15.15, but if you stay longer, it goes down to 13.67 and even further to 12.3. Take a look at Nifty 200 value 30. Same. Starts at 13.84, goes down to 11.87 and further goes down to 10.47. Only Nifty 50 value 20 is able to hold the ground. Starts at 16.06, 3-year rolling return. Holds good at 16.08 for 5 years and then falls down to 15.32 at 7 years. But take a look at the Nifty 500. Nifty 500 is consistent. 13.54, 13.78, 13.21, almost in the range of 13.2, 13.5. It's flat, whether it is 3-year, 5-year, or 7-year. So at a shorter interval, the values strategies might beat the Nifty 500 benchmark. But as you give more time, then the value strategies will start to underperform. So that's the first learning that we see, the insight that we see, that value strategies over a longer period of time, they start to underperform the benchmark. Second thing is value strategies are cyclical. So the longer the time that you spend, then you might see deterioration in your returns. That's the second insight. The third insight is, except for Nifty 50 value 20, the remaining value indices are not a good strategies to hold because of the inherent protection of downside by kicking out the stocks which are going down in the price. So Nifty 50 value 20 is able to hold on to only those winners and continue to reap benefits. That's why you see the outperformance of Nifty 50 value 20 continuing even after 3-year, 5-year, 7-year rolling returns and consistently beating the benchmark. So far, we've only seen the returns. In returns point of view, Nifty 50 value 20 beats hands down. Let's now check the drawdowns. The drawdowns are a critical part of the value strategy. If you remember in my previous discussion, in the previous video also that I mentioned, that the value strategies give away their entire gains during downturns, and they again fall back even below the benchmarks. So to get a visual proof, let's compare the NAVs which I've plotted from January 2009. So the red colored line is the Nifty 500 and the blue colored line is the Nifty value strategies. So I'm starting with Nifty 500 value 50. Take a look at the value strategy, the blue colored one. It outperforms during the bull run and then it slowly gives away its returns and it falls even more rapidly than Nifty 500, so that it comes and at some point it goes even below the Nifty 500. And then again, it starts to outshine or overperform and then again gives away all its excess returns and again converges with Nifty 500. Same story. Again, it outperforms and gives away all its returns and underperforms. And then again, the story starts. It again outperforms and again gives away. Again, right now we are seeing the outperformance peak that has happened. And again, it is now starting to underperform the Nifty 500. So this periods of outperformance, underperformance is common in value strategies, especially in Nifty 500 value 50 and Nifty 200 value 30. Let's take a look at Nifty 200 value 30 also. Same story. Outperformance gives away and converges with Nifty 500. Again, outperformance gives away and converges. Outperformance and gives away and deteriorates. And again, outperforms and then again starts to converge. And this is the story from 2009 Jan 1 onwards. It will look the same in 2005 also, if you see. During the underperformance of GFC crisis, also it has gone even below the Nifty 500. I have not plotted because the data points for Nifty 50 value 20 are only from January 2009. But the key takeaway is the same. The value outperforms when the markets are up, and it gives away all its returns during downturn and converges with Nifty 500. Exception is Nifty 50 value 20. Let's take a look at the Nifty 50 value 20's graph. So you see the Nifty 50 value 20, it outperforms during the bull runs, but it doesn't give away more than the Nifty 500. It gives away just as much as what Nifty 500 is giving. And then again, when upturn starts, it rises. And then again, in the downfall, it gives the same as what Nifty 500 gives, and then thereby maintaining that distance between Nifty 500 and Nifty 50 value 20. So all the downside that has been protected will help ultimately in compounding and keeping the strategy drift away from Nifty 500. So as you can see, the constant distance between Nifty 500 and Nifty 50 value 20 is because the downside protection, minimal drawdowns as compared to the other strategies. So let's take a look at the drawdowns of first Nifty 500 value 50. And then we'll take a look at Nifty 200 value 30 and we'll finally compare it with Nifty 50 value 20. So the red colored one is Nifty 500. This is the drawdowns. And the blue colored one is the Nifty 500 value 50. So you see the blue colored ones are even more sharper than Nifty 500. The blue colored ones, you see, they're almost at 60%, 65% compared to Nifty 500, which is somewhere in the range of 30%, the drawdowns. So all the excess returns is given away during these turns where the blue is deeper than the red. Same story again, even this period also. The blue is deeper than the red. It gives away all the excess returns that it has gained. That's the problem with Nifty's value strategies. The drawdowns are brutal and it gives away whatever returns that you have accumulated unless you know exactly when to time and get out from the value strategies. Now let's take a look at the Nifty 200 value 30 and compare its drawdowns. Same. The red colored one is Nifty 500 and the blue colored one is Nifty 200 value 30. So the same story. The Nifty 500 is in the red colored one and Nifty 200 value 30 is in blue colored, and the blue colored ones are even sharper than Nifty 500. So you see more brutal drawdowns, frequent drawdowns, and they are also in the range of 40%, 60% as compared to 20 to 30% in Nifty 500. And whenever there is a drawdown, value strategies are the first to come down crashing, and thereby giving all whatever gains that they have accumulated. So this brutal drawdowns, you compare that with Nifty 50 value 20. So it exactly mimics the Nifty 500's drawdowns. In fact, the drawdowns of Nifty 50 value 20 are even better than Nifty 500. So you see the blue colored ones are actually below or not as worse as the red colored ones, which are Nifty 500. Even during the COVID also, the Nifty 500 crashed up to 35, 38%, whereas Nifty 50 value 20 did correct only by 24, 25%. So thereby, this is the key difference that is helping Nifty's 50 value 20's returns in improving is its downside protection mechanism. And how is it getting this downside protection mechanism, which is different from Nifty 200 value 30 and Nifty 500 value 50? It comes down to the methodology that we have seen earlier. The methodology is Nifty 50 value 20 has 40% weightage to ROCE, which doesn't have any impact or which doesn't depend on price at all. This purely price agnostic metric, which is purely depending on the efficiency of the company, and 10% to dividend yield. The remaining 50% are towards earnings to price and book to price. Whereas the Nifty 500 value 50 and Nifty 200 value 30, they all are in some way related to price. So they're inversely related to price. So if a price of a stock starts to fall, the rank of this stock in terms of value will start to go up, and the value indices will start to hold them even more longer because the ranks are better. Whereas Nifty 50 value 20 doesn't do that. It gives only 50% weightage to price. Thereby, a falling stock is not necessarily loved by Nifty 50 value 20. The other thing that I also mentioned is Nifty 50 value 20. Since the universe is only top Nifty 50 stocks, if a stock starts to fall down, it gets kicked away from Nifty 50, and thereby we're cutting our losers and letting the winners run. So in a way, it also has the tinge of momentum in it. Thereby, this index Nifty 50 value 20 outperforms in the drawdowns as well as during the upturns. So that's what is seen in the max drawdowns. Look at the comparison when you compare. The drawdowns of Nifty 50 value 20 are only 30% in the last 16 years, whereas it is 64% in Nifty 500 value 50, 58% in Nifty 200 value 30, and 38% in Nifty 500. So the drawdowns are even better than Nifty 500. And if you take a look at the volatility during this entire 16-year period, you see that the volatility is also less compared to other strategies. The volatility of Nifty 500 value 50 is 26%. Same with the Nifty 200 value 30, 26%. Nifty 500 is 20.5%, whereas Nifty 50 value 20 is only 18%. And then you see that the Sharpe ratio is actually greater than 1 in Nifty 50 value 20, because I'm taking the excess returns divided by the volatility. That number, let's say I'm taking 19.17 divided by 18.13. So this is 1.06, Sharpe ratio greater than 1. So there's a higher reward per unit of risk in Nifty 50 value 20 compared to even the benchmark Nifty 500 as well as the other two value strategies. So that's the beauty of Nifty 50 value 20. So not all value strategies are same. There is difference in it. So we have seen in terms of the methodology, and we've also seen in terms of returns. So one more thing also I wanted to show, that is Nifty 50 value 20. I've also been looking at a couple of interesting data points. I wanted to show that. I've also been interested in seeing how many 3-year rolling return periods were there where the returns were less than 0%. So I'll show why I'm interested in that. Let's see. These are all the 3-year rolling return period for different time frames. So we have around 3,316 data points, 3,316 individual data points with which we have calculated the 3-year rolling return period. So what I'm going to do is I'm going to see the count of a number of 3-year rolling return periods which are less than 0 returns. So for Nifty 500 value 50, you see I'll write it here so that it is clear. So for Nifty 500 value 50, there are 725 records of instances where the returns, 3-year rolling return, were negative. For Nifty 50 value 20, it is 0. For Nifty 200 value 30, it is 625. For Nifty 500, it is 122. So as I mentioned, the total count of such 3-year rolling returns is 3316 time frame 3316 instances we have. So if I look at the percentage, around 22% of the times, if you invest in a Nifty 500 value 50 strategy and stay for a 3-year period, you might end up getting negative returns. That's the meaning of this metric. Whereas it is 0% in Nifty 50 value 20. That's the historical data that is saying that if you have invested in Nifty 50 value 20 and waited for 3-year time period, definitely your returns would have been greater than 0. And that number is 20% for Nifty 200 value 30, and for Nifty 500 is only 4%. So the benchmark also did decently well. If you're invested in Nifty 500 and stayed for 3 years, 96% of the chance was that you would have gotten positive returns. So that's the key takeaway that I had from Nifty 50 value 20. Also, just take a look at, let's say, how many times do we beat the returns of FD. So I'm going to put it as 8% and see how many times does this strategy beat the FD benchmark. So we see that 70% of the time Nifty 500 value 50 beats the FD returns. Whereas in case of Nifty 500 is 80% of the times it beats the FD returns. Whereas for Nifty 50 value 20, 90% of the time it beats the FD returns. Whereas for Nifty 200 value 30, only 66% of the time it beats the FD returns. So the more probability that a strategy beats the FD returns in a longer time frame, that's the strategy that we would love to go ahead and invest in it. So that's the major takeaway that I have from this video. Nifty 50 value 20 is something that everyone should take a look at, study more about this index, and it might be useful in one's portfolio. Not saying that you should go ahead and fully invest in it, because I'm not a CB-based advisor. You should do your own independent research, but this can be a wonderful instrument in your arsenal of investing in different asset classes or in different equity strategies. That is Nifty 50 value 20. All right, that's it. We'll take a look at different approaches of creating value in the next video. Thanks a lot. Have a nice day. Bye.